Hello and welcome to Bunnex Investment Group. Today we are going to talk about risk management. The goal of any trader is to turn profits on a regular basis, yet so few people ever really make consistent money as traders. What accounts for the small percentage of traders who are consistently successful is what we are going to discuss in this video. Before we go further, please make sure you turn your notification bell on so that you'll be notified each and every time I upload a new video. The painful trading journey. For amateur traders, the only challenge is to find a way to make money. Once they get tips and ways to justify buying or selling, they feel they are good to go. Usually after 90 days or so days of losing money, they would think of developing a reliable trading strategy or purchase one. Then after that, trading should be easy, right? All you have to do is to follow the rules and the money will fall in your lap. At this point, the amateurs discover that trading can turn into one of the most frustrating experiences they will ever face. So, what is risk management? Risk management in trading is defined as what percentage of your account would be lost if your trade hits your stop loss. The biggest merit of trading with a defined risk is to give you an emotional preparation if a stop loss happens. What makes the risk defined is the lot size we use. There is a mobile app that can help you solve the mathematics behind calculating your risk management. Here is the example.
So here we are, guys. This is the application that I was talking about, the Forex calculator. You have all the parameters to choose from. The account currency, meaning the best currency. So on account currency, you can actually change the account currency to your preferred one. The South African rand, Russian ruble, Chinese yuan, or the US dollar, the euro, or the pound. Then on currency pairs, we have a lot of currency pairs where you can choose from. On these ones, you are free to choose any currency pair that you wish to. Then on account balance, that is where you put in your account balance. For example, you have 10,000 in your account. Then stop loss in pips is at 50 pips. Then risk by percentage, for instance, we'll risk 2%. Then calculate. The amount that we are going to risk on this trade is $200, and the lot size that we will use is 0.4. We take the lot size indicated on standard lots, which is 0.4 on our trade, meaning that if we are risking $200, we are anticipating to gain 4% of our account, which is $400. So basically that's how you do it. Then there are other pairs like USDs that are difficult to calculate the number of pairs. So you just put USDs, then your account balance, then you go on stop loss by price, where you enter your entry price, for instance 17.562, then stop loss 17.2345, then risk 2%, calculate. Therefore our standard lots will be 0.1 within this range of risk. So basically that's how you use this app. It will be very, very easy to calculate your lot sizes.
Mastering the market maker pick can allow you to trade with a pure 3:1 risk to reward ratio, meaning you can lose 3 times and negate all the losses with one winning trade. Let's say the stop loss on each trade is 40 pips. 3 stop outs will give you a negative of 120 pips, and getting one win of 120 will cover all the lost pips. The idea is that we use a consistent lot size for the win-loss cycle. If we take a stop out, we use the same lot until the loss is negated. So how much must you risk on each trade? I recommend risking not more than 5%. 2% is the most ideal one that will always keep your emotions in check whenever the market goes against you. After taking a stop out, you must come back with the same lot size until you cover the loss. If your balance is only set back 2%, at each loss, you are sure to avoid margin issues for the third and fourth losing trades. The basic idea is that as you hit winning trades, you increase your lot size, and as you hit losing cycles of 3 or 4 consecutive stop outs, you decrease your lot size. There is no reason for a single loss, nor even 2 consecutive losses, to blow your account. If you just have a strategy to manage risk, you can simply come back clear-minded and can trade without fear when a signal reappears. Example, so let's say you are a 2:1 risk to reward ratio trader. This can be any number of pips you prefer. You can have an average performance of 55%, that is 20 trades. That is actually out of 20 trades, you only have 11 wins. With our defined risk to reward ratio, we have 50 pips on the take profit and 25 pips on the stop loss. So let's do the math. For winners, that will be 11 multiplied by 50, which sums up to 550 pips. Then for losers, that will be 9 multiplied by 25 pips on the stop loss, which sums up to 225. So our net profit after removing the expenses from this gross profit, that will be 550 minus 225, which will be 325 pips. Let's say you are trading with 10 standards. This will be multiplied by $100, which will be $32,500 with only 55% accuracy. So here are the rules for proper risk management. Number 1, always define your risk by choosing the lot size, which is -2 to -5% of your balance at your stop loss. Always use risk to reward ratio that is greater than 1:1. That is, the take profit level is greater than the stop loss level. And number 3, fight to trade with a greater than 50% accuracy, and you will have a positive equity growth. It's not always 50%. You can actually go below 50% to as minimal as 45% and still be in profit. Here are the risk management don'ts. Number 1, never increase your lot sizes impulsively. Number 2, hold your chest right now as you are watching this video. Hold your chest and say, I will never marry my trades or force my entries. Then number 3, do not let your emotions take control because you have math on your side. Human beings have a tendency of wanting to gain back what they've lost in the shortest period of time. That is why whenever you lose, you try to force a trade to easily get back what you've lost quickly. That experience will be making you succumb to emotions. So you have to control those emotions and always remember that math is on your side. Then number 4, do not move your stop loss when it is being approached, because the first stop loss is the cheapest. I'm sure you've done it 1 or 2 times in your career, that whenever you see the market approaching your stop loss, your first stop loss, you start to move it further from its initial position. Never do that, because the first one was the cheapest, and the first one is the only one that you were prepared emotionally. Then number 5, do not put multiple positions which add up to greater than your risk. As I speak, the social media is currently flooded with such trading style, where you see $100 account having 0.05 lot sizes, plenty of them, if not 10 or 15 of them at one point. That will only be increasing your risk. Number 6, do not forget the discipline to keep the risk plan as described. Yes, of course, you may have a document that you have written or that you have stuck on your wall at your trading terminal, but you won't be following it. So do not forget to discipline. Actually, force yourself to stick to that plan as described. Then lastly, do not miscalculate exotic pairs. Always use a lot size calculator. There are pairs like USD against the Mexican peso. They have an unusual lot size value. They move a lot of pips than any other pair within the common assets. So it's better to use a lot size calculator and not to do it mentally, because a 0.1 lot size on euro against dollar is different to a 0.1 lot size on USD against MXN. So always use a lot size when trading exotic pairs. In conclusion, following your plan without deviation, distracting thoughts, or hesitation to act will take long. If you wanted to be a professional golfer, it wouldn't be unusual to dedicate yourself to hitting 10,000 or more golf balls every day. This is the same thing that you should do to yourself. You have to put in the hours, put in the effort to stick to your discipline. So this means you need to put in the effort in mastering your discipline. On that note, thank you for watching. Like and subscribe, and check out our free signals Telegram channel. Here's the link in red. You can just type it in your browser and join the free signals Telegram channel. It will definitely help you. And please check out some of our videos on our channel. That is the simplified or summarized market maker method course. It will definitely help you. Share with someone this risk management video whom you think is having trouble to increase their equity.